Infrastructure and real estate, collectively known as real assets, represent tangible, essential components of daily life: roads, power grids, and housing. As economies face shifting market cycles, geopolitical instability, and regulatory changes, real assets offer a unique mix of challenges and opportunities. Given their essential role in society, understanding these dynamics is crucial for investors seeking to navigate this sector effectively. Jagpaul Singh, formerly of the Carlyle Group, has over a decade of experience in the real estate market. His expertise lies in understanding the evolving interplay between regulatory changes, economic cycles, and investment strategies, making him a trusted authority in assessing macroeconomic impacts on asset valuations and portfolio management. Challenges: regulatory risk. Regulatory environments, influenced by shifting local and global policies, pose significant risks. Even established assets like toll roads with inflation-linked pricing can face sudden changes in politically unstable regions. Geopolitical unrest or unexpected regulatory shifts in emerging markets can disrupt cash flow, stability, and increase investment risks. Capital markets and interest rates. Volatile interest rates challenge access to capital for real asset investments. Despite hopes for future rate cuts by central banks like the U.S. Federal Reserve, persistent inflation may keep rates higher for longer, reducing yield potential. Global disparities in monetary policies further complicate cross-regional investment strategies, adding a layer of complexity to capital allocation. Long-term commitment. Investments in infrastructure and real estate typically require long-term commitments to achieve returns, often locking up capital for extended periods. Although alternative structures like REITs or infrastructure funds can offer shorter-term options, higher returns generally favor long-horizon investments. This liquidity constraint poses challenges for investors seeking more agile portfolios. According to Jagpaul Singh, understanding the local regulatory landscape is essential, as small policy shifts can substantially impact returns, particularly in emerging markets where unpredictability is high. Opportunities: stable, inflation-linked cash flow. The essential nature of real assets ensures long-term, predictable cash flows, often linked to inflation. Assets like toll roads, energy plants, and social infrastructure can adjust pricing with inflation, providing resilience in inflationary environments. For instance, power purchase agreements, PPAs, in energy projects often include inflation adjustment clauses, protecting investor returns. This makes real assets a valuable complement to fixed income allocations, offering both stability and inflation protection. Diversification and ESG opportunities. Incorporating real assets into a portfolio allows diversification into sectors like energy and transportation, which are less correlated with traditional stocks and bonds. This reduces portfolio risk during economic volatility or geopolitical uncertainty. Investments in these areas offer both financial returns and social or environmental benefits, increasingly valued by stakeholders. Long-term investments in infrastructure can provide a unique hedge against inflation and economic downturns, says Jagpaul Singh. Investing in essential assets with inflation-linked cash flows offers a rare combination of stability and growth potential. Real assets deliver a blend of stable cash flows, inflation protection, and diversification benefits, significantly enhancing a well-balanced portfolio. While regulatory risks, capital constraints, and long-term commitments require careful planning, the inelastic demand and essential nature of these assets ensure potential for sustained growth and resilience. For forward-looking investors, real assets remain central to modern investment strategies.